Do you want to start investing but you have no idea where to put your money? In this video, let me show you 3 different methods that you can follow to create an investment plan that you can follow with ease. Each of these methods is actually going to take you less than 5 minutes to complete. And after those 5 minutes, with any method that you decide to follow, you're going to have your plan ready and will know exactly where to put your money month after month. So let's talk immediately about the first method, which is just called the 110 rule. This rule is very simple. It's just about taking the number 110, subtracting your age, and use the resulting number as the percentage of your investments that you're going to destine towards stocks. The remaining percentage you would invest on bonds. So for example, I'm 30 years old. That means that from 110, I would subtract 30. The result is 80. I, according to this rule, should invest 80% of my investment, of the money that I'm going to invest, in stocks, and the remaining 20% in bonds. This is a very, very simple rule. With just one subtraction, we pretty much have the entire investment plan created. And if we want to make things very easy, that percentage that this rule says that we should invest in stocks, we could just invest in an ETF like Vanguard's VT, which invests in more than 9,400 companies all across the globe. With this Vanguard VT ETF, which is the Vanguard Total World Stock ETF, like I said, we would be investing in 9,473 different companies, and we're going to find that 10.4% of our money would be invested on emerging markets. This is, by the way, percentages at the moment of recording this video. This can change a little all the time. If you want to know about the updated values, just go to Vanguard's site. I am going to leave the link down below for all the updated information. But anyway, at the moment of recording this video, 16.2% of our money invested in this VT ETF would go to Europe, 11.1% to the Pacific, 62% to North America. If we want to know not by region, but by country, we can navigate over here to markets, and we see that 59% would be invested in the US, 6.3 in Japan, 4.1 the UK, 3.5 China, Canada, France, and so on. So this ETF indeed makes it very easy for us to invest in a very diversified way, investing all across the world on thousands and thousands of companies, so that if 1, 2, 100, even 1,000 companies fail, it just doesn't matter that much because this ETF is investing on so many more companies. And of course, this ETF would keep on updating itself, remove some of the companies, add new ones. You can of course invest on this ETF in many different ways. You can, for example, create an account on Accetrade and start investing through there. But also notice that right here on the Vanguard side, we see that this is also available as an Admiral Shares mutual fund. So if we want to do it that way, we can actually create an account here with Vanguard. We're going to have this mutual fund, although do keep in mind that the minimum investment in this case would be $3,000. Whereas if you invest on the ETF directly, that is just the price of the ETF, which currently sits around $90. As for the percentage that we would invest in bonds, one of the very best ways to invest in bonds is through Treasury Direct in the US. So we can actually buy United States bonds in the long term for 20, 30 years even. And we would be using, in this example that I'm 30 years old, 20% of our investment, we could invest in those bonds. So this is the very first way to create this plan. This plan is amazing because it is very simple to create and it already takes into account the fact that as we get older, we usually can withstand less risk. So older people would invest much less on stocks than people who are in their 20s or in their 30s. However, this is not a very great method to create your investment plan because it doesn't take into account many different more variables, such as the risk that you can actually take independent of your age. Maybe you have kids, maybe you have a mortgage, and so on. So all of that is adding to the risk that you're already taking, so you should take less risk with your investments. There is where the second method comes into play, which actually starts to take into account your personal experience, your personal risk, independent of your age. And that second method is answering a questionnaire by Vanguard itself, the company behind this ETF that I just mentioned. So Vanguard, they have this questionnaire for investors to define how exactly they should invest. By the end of answering these 11 questions, you're actually going to receive a plan that is tailored to you of how much of your investments you should put towards stocks and how much towards bonds. So I am going to leave the link to this questionnaire down below in the description, but let's just go ahead and answer it very quickly in here. Let's say that I want to withdraw my investments in a period of more than 15 years. Let's just move through these very quickly. The last question, by the way, is your current asset allocation. So how much of your money is in short-term reserves, perhaps your emergency fund or things like that. Let's say that 20%. I am going to say that 20% is in bonds and the remaining 60 is in stocks. Anyway, I get the results, and these results now actually take into consideration more personal stuff regarding, of course, the 11 questions that I just answered about the risk that I'm going to take and my previous experience investing, and when do I want to start withdrawing money from my investments, and so on. All of this means that this eventual plan that is created is one that is much more tailored to you, and it doesn't even take into account how old you are. It never asks your birthday or your age or anything, because it knows that independent of age, different people need the money at different times for different reasons and invest differently. So anyway, in this example, it says that I should invest 60% in stocks, 40% in bonds. And again, one way that we could invest that 60% in stocks is through the VT ETF. By the way, I am realizing that I'm mentioning Vanguard a lot, but the only reason that I mention Vanguard a lot is because they have very, very cheap ETFs. Let me just show you that ETF that I was mentioning. It has a 0.1% expense ratio. That is actually a very good deal. Vanguard generally is going to be a company that is going to allow you to invest for very cheap. But anyway, the remaining 40% in bonds, I could invest it through Treasury Direct. So I would be investing in the debt of the United States. This is a very good method to create an investment plan because it is very tailored. It takes into account the risk that we are willing to take and so on. But it is not a very good plan because it only considers percentage to invest in bonds and percentage to invest in stocks. There is where the third method comes in, which is to just use the David Swensen model. David Swensen was the head of investments at Yale until his death a couple of years ago. He created this Swensen model that defined that we should invest 30% of our portfolio in US stocks, 15% in other developed markets stocks, 5% in emerging market stocks, 20% in real estate, 15% in normal government debt, and the last 15% in inflation-protected government debt. So with this model, we can actually start to tailor much more how much of our investments go to certain parts of the world. If we just use VT as stocks, we're investing everywhere, but we have no control of how much we're investing in the US or in Europe and so on. The percentages are defined and we have nothing to do with them. With the Swensen model, however, we could use Vanguard's VOO ETF to invest in the S&P 500, the 500 largest companies in the US, just the US. We could use the ETF VEA to invest on other developed markets, so mainly Europe and some parts of Asia, but we can define how much we destine towards that ETF. Of course, the Swensen model defines 15%, but we could tailor it to our needs at any time. Of course, this is just a model. We can personalize it. For the 5% that we would invest in emerging markets, we could use Vanguard's VWO ETF. For the 20% that would go towards real estate, we could use Vanguard's VNQ ETF. And again, I mentioned Vanguard only because their ETFs are going to be the cheapest that we can normally find. But anyway, the 15% that we should invest in government debt, we could again use Treasury Direct to invest in bonds, and finally the 15% that we should invest in inflation-protected government debt. We could also use Treasury Direct. We can find TIPS, Treasury Inflation-Protected Securities, directly from Treasury Direct. So again, this is a model. Normally we would want to personalize these percentages. For example, I just took this questionnaire and it says that I should destine 60% towards stocks. The Swensen model says that we should use 50% in stocks and another 20% in real estate, which is not exactly stocks, but we could consider this investment as kind of stocks because the value of real estate fluctuates similar to stocks. Although maybe not as much, but let's just say that the Swensen model says originally that we should use 70% of our investment and put it in stocks. This questionnaire says that I should use only 60. So, using these couple of methods together, we could define that instead of using the Swensen model as is, we are going to take that 40% that the questionnaire is saying that I should invest in bonds and divide it in two. 20% in normal bonds, 20% in inflation-protected bonds. The remaining 60%, I could start to divide it in real estate and US stocks, emerging market stocks, developed market stocks, as I need. At any point, whatever method that you decide to use to create your investment plan, you are going to need help maintaining those percentages. Because let's say, for example, that you should invest 60% in stocks, 40% in bonds, and stocks fall. Suddenly you may have 50-50. You should know how to invest your future money so that you are actually following your plan, making it go back to 60-40. If you are only investing in two assets, stocks and bonds, that is very simple. Quick math can help you solve it. But if you start to have more investments, perhaps following the Swensen model, my Portfolify tool could also help. You're going to have to pardon me because it is all in Spanish, but you can actually navigate to Portfolify.com and get my spreadsheet for about $5. All you have to do is enter your name, enter your email, and pay the 99 Mexican pesos, which again is around $5. And I am going to give you access to this Google Sheet spreadsheet. Again, I know that this is in Spanish. If there is enough demand for it in English, I will be translating it. But anyway, the first thing that you would do is enter right here the currency that you want to use, for example, US dollars. And you're going to enter down below your plan. So for example, let's say that I'm going to follow the Swensen model, which is actually exactly what is being defined in here. So this is US stocks, developed market stocks, emerging market stocks, real estate, bonds, and TIPS, which is again Treasury inflation protected securities. And I define the percentages from the Swensen model, but I can of course change them. The next thing that I would have to do is navigate over to my portfolio. This is the dashboard. This is my portfolio, and start defining what am I going to be buying. For example, the ETF that I mentioned for the US, which in here I would select US stocks, the ETF for developed markets, the ETF for emerging markets, the ETF for real estate. In here, I am actually taking into account ETFs instead of using Treasury Direct. You could consider this as well. BND for normal bonds and VTIP for the TIPS, the Treasury Inflation Protected Securities anyway. And over here, you would write how many stocks have you bought of each of these ETFs. So let's say that I have one stock of VOO, two stocks of VEA, and so on. This spreadsheet is going to be very helpful because it of course is going to take the current value of the stocks and it is going to get the current value of your portfolio. But where it is going to be crucial is when you write over here in the dashboard, what is your next investment? So let's say that I want to invest $1,000. This spreadsheet is going to tell you exactly how much you should invest in what section of your portfolio. So in this example, because the current percentages are a bit off from the objective, you would have to invest in this way so that the new percentages are actually closer to the objective. Keep in mind that going back to the actual objective can take more than 1 month, more than one investment, so these new percentages might not always be exactly the same as the objective, but this spreadsheet is going to help you get there. But anyway, there you have it, those 3 different methods that you can use to create your investment plan and know exactly where to destine your new money each and every month. This tool is also very helpful, I think, for everyone that is investing and wants to follow a plan. Again, if you can use it in Spanish, go ahead and use it. If not, leave a comment down below. And if I see that there is enough demand, this is a brand new channel after all, there might not be enough demand, but if there is, I will make sure to translate this. Do keep in mind, by the way, something very important that I was always forgetting. Whatever plan that you create, make sure that you update it at the very least, every 2 years, because after 2 years, your life might be completely different. For example, you are at least 2 years older, so the first method would mean that you have to change the percentages. Maybe there is less risk that you can take, so the questionnaire from Vanguard might give you a different result. And again, those 2 methods could influence the Swensen model so that the percentages actually change a little bit. But anyway, I hope that this video has been useful. If it has, liking the video, subscribing to the channel would really mean a lot. But anyway, catch you on the next one.